Let's now look at illustration number 17. Acquirer Limited enters into an arrangement with the shareholders of Target Limited, wherein Acquirer Limited will purchase the shares of Target Limited in a share swap agreement. All right. Let us actually, before reading the next part of the paragraph or the question, let us actually understand what is happening over here. We have got Acquirer Limited or A Limited, and we have got T Limited. Now, T Limited has got certain shareholders. The shareholders are basically owning T Limited. What we're doing is A Limited is entering into an arrangement with the shareholders of T Limited, where A Limited is going to say that it will issue number of equity shares. It is going to issue X number of equity shares. And what these shareholders will have to do is they will have to transfer the ownership of T Limited shares. They'll transfer the ownership of T Limited shares to A Limited. All right. So A Limited will basically receive equity shares in T Limited. A Limited is going to receive equity shares in T Limited. So after this transaction, what will happen is A Limited will become the shareholder of T Limited. After this transaction, A Limited will be owning all the shares in T Limited, and T Limited is going to become a subsidiary of A Limited. It will become a wholly owned subsidiary of A Limited. All right, so the acquirer is entering into an arrangement with the shareholders, and the shareholders will basically receive X number of equity shares in of A Limited. A Limited is going to deliver its own equity shares to the shareholders in as a consideration. What A Limited will actually happen to receive is A Limited will receive the equity shares in T Limited, and after the acquisition, A Limited and T Limited continue to exist, and T Limited is going to become a subsidiary of A Limited. All right, A Limited will be the holding company, and T Limited will be the subsidiary. All right, so let's start reading again. Acquirer Limited enters into an arrangement with the shareholders of Target, wherein will purchase the shares of the Target in a share swap arrangement. Why is it being called as a share swap? Because I am receiving shares and I'm giving shares. A Limited is actually receiving equity shares in T, and it's delivering its own equity shares. It's delivering its own equity shares, and therefore it's a share swap arrangement against a variable amount of cash, i.e., the market value of Target Limited's equity shares. The share swap ratio is agreed as 1 is to 5, i.e., one equity share of acquirer for every 5 equity shares in Target. All right. So the exchange ratio has been decided as 1 is to 5, which means A Limited is going to deliver one equity shares. It's going to actually deliver one equity shares for 5 equity shares in T Limited. All right. So the conversion ratio is determined today. All right. Let's assume that the conversion ratio is determined today. The settlement will actually happen 3 months later. All right. I am deciding today that I will deliver one equity share for every 5 shares in T Limited, and but the settlement of issuing one equity shares and acquiring 5 shares is going to happen at the end of 3 months. All right. The question is, will this transaction be classified as equity or financial liability in the books of Acquirer Limited? Okay, over here it actually does not pass the fixed for fixed test. It does not pass the fixed for fixed test because although A Limited has an obligation to deliver a fixed number of equity shares, A Limited has an obligation to deliver fixed number of equity shares of one share. A Limited will be receiving a variable amount of consideration. Variable amount of consideration because the 5 equity shares worth is not going to remain fixed. All right. If the share price of T Limited increases, I will receive a higher worth. If the share price of T Limited falls, A Limited will receive a lower worth. All right. So the consideration that A Limited is receiving is variable. It is not fixed, but it is variable. All right. At the end of 3 months, whatever is the share price, depending on that, I am actually going to receive consideration. All right. So over here, it is not passing the fixed for fixed test. It is actually a fixed, the A Limited has an obligation to issue fixed number of equity shares for a variable amount of consideration, and therefore instrument will be classified as a financial liability. It will be classified as a financial liability in the books of Acquirer Limited. All right, this will be classified as a financial liability in the books of Acquirer Limited, and it won't be classified as a equity component. All right, so in let us, because the conversion ratio and the acquisition is determined today, because it is the acquisition is happening today, what A Limited will actually recognize is it will recognize investment in T Limited, all right, because the transaction is finalized and the agreement has been entered into. The settlement will happen after 3 months, but the acquisition has actually taken place, and therefore I will recognize the investment in T Limited and I will credit financial liability. I will not credit equity, I will credit financial liability. And at the end of third month, when actually the shares are being issued, at that point, financial liability will be de-recognized and equity will be recognized. All right. At that point in time, I will de-recognize the financial liability and I will recognize equity. So with that, we're done with illustration number 17.